Yo, it's your boy, the insurance junkie, your fiduciary fellow, the all-star advisor Alonzo Hall, and I've returned today with another ADH wealth solution. Today, we'll begin to discuss fulfilling all of your financial needs. To contribute to channel growth, the links are in the description. To schedule an appointment of your own, or to purchase life insurance directly up to $1 million with no medical exam and an instant decision, my information is in the description. Lastly, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. And now, here's our next feature. Salute. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. And I've returned today to whap and tap on your head with another ADH wealth solution. Today, we're actually going to continue a video I did a little while back about amortization schedules and interest rates. I decided to break it up a little bit because it's a lot to consume or ingest. Before we go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth, to purchase life insurance directly up to $1 million with an instant decision or no medical exam, or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description. As we proceed to give you what you need, we're continuing our amortization and interest rate discussion. All about interest rates. When it comes to figuring out a loan amortization schedule, interest rates are the most common spot where we see our customers get confused. If you don't truly understand the terminology and the way interest rates works, it makes it easy to miscalculate the total cost of your loan, make mistakes in your debt amortization schedule, or make inaccurate assumptions when comparing loan products. Let's break down the Reader's Digest version of everything you need to know about interest on your amortizing business loan. Simple versus compound interest. Though the percentage of interest paid on a loan can look congruent between loan products, the type of interest can make a big difference to the actual cost of your loan. If your loan has a simple interest rate, which includes loans with factor rates, the interest is calculated only on the principal amount. For a $10,000 loan with a simple interest rate of 25%, your total cost, not including fees, is $12,500. Done. But most loans have compound interest, meaning the interest is calculated both on the principal loan amount and the accumulated interest. The rate at which compound interest accrues depends on the compounding frequency, daily, weekly, or monthly, which typically matches the payment frequency. So the more payments you make, the more compound interest you'll accrue. Types of interest rates. The way that interest rates are expressed can vary among lenders and among loan products. While it can be tempting to compare percentage interest rates from different loan products equally, doing so can leave out a number of factors and paint an entirely inaccurate picture of your true cost of borrowing. Let's read on to make sure you understand the interest rate for your individual loan product and that you are plugging the correct numbers into your loan amortization schedule template. Annual interest rate. Customarily, if you have a multi-year term loan with monthly payments, interest rates will be expressed as an annual interest rate. While this is close to an accurate estimation of the actual annual cost of your loan, it does not include the cost of origination and other fees. Factor rates. Used specifically for short-term loans with daily or weekly payments, a factor rate is the cost of borrowing expressed as a decimal figure. Factor rates typically range from 1.1 to 1.5 depending on your industry, how long you've been in business, your credit history, and your average monthly sales. Calculate the total amount owed on your short-term loan by multiplying the factor rate by the amount borrowed. For example, if you borrow $10,000 at a factor rate of 1.25% for a 6-month term, the total amount you'll need to repay is $12,500, or 10,000 times 1.25, which equals 12,500. One of the most common misconceptions we see from borrowers is the assumption that a factor rate of 1.25% is equivalent to a 25% interest rate. This is not correct because of the term of the loan and because the cost is charged to the principal when the loan is originated. Factor rates can't be compared as equivalent to interest rates in this way. To compare apples to apples, you'll need to calculate the loan's effective APR. Effective APR. This here is the most important interest-related concept you need in order to make sure you're making equal comparisons when shopping for loans. The annual percentage rate, or APR, of a loan takes into account the loan's principal amount, term, or length in months or years, interest rate, and any fees, including origination fees. In the traditional lending sphere, banks and credit card companies are required to disclose the APR for any loan or line of credit, but alternative lenders aren't required to play by those rules. That means the way your loan's interest rate is expressed through any of the interest rate types above can leave out a lot of factors that may lead to your owing more than you expected. To make sure you're comparing apples to apples and plugging in accurate figures into your loan amortization schedule template, try using an APR calculator. Reduced interest payments over time. When you review your loan amortization schedule, you might notice that in your first several payments, a larger portion of your payment is going toward the interest of your loan. As you scan down your schedule, you'll see that over time the amount of your payment going toward interest reduces as more and more of your payments start to be applied toward the principal value of your loan. For example, let's imagine we have a 10-year, $100,000 term loan with a 10% annual interest rate. If you put those numbers into a monthly schedule template, you'll see something like this. Look at the very first payment of the schedule. You'll see that out of the total monthly payment of $1,321.51, nearly two-thirds of that payment, $833.33 to be exact, is going toward interest on the loan, with only $488.17 going toward paying down the actual principal that you borrowed. So much for our simple math. By contrast, if we scroll down to the last several payments on this schedule, you'll see for the very last monthly payment, almost all of the payment, $1,299.66, goes towards the principal, with a mere $10.92 being applied to that last bit of interest. So why does this happen? It comes down to the fact that the beginning balance from the first payment, $100,000, is much higher than the beginning balance on the last payment, $1,310.59. So when you apply the compounded interest rate to that first number, you come out with a much higher interest payment than for the balance of the last payment. Understanding extra payments. In the best case scenario, taking on a business loan will have launched you on a path to off-the-charts revenue growth and profit potential. It's practically raining money in your world, right? Or at least you'll have a little extra cash on hand. If over the course of your loan, your business has additional cash available on hand, either in a lump sum or at regular intervals, you might choose to make extra payments on your loan. Making extra payments can both reduce the length of your loan and save you money in compounding interest. Let's look at three different ways that borrowers can typically choose to make extra payments and calculate time and money saved through extra payments in each scenario. Regular extra payments. These are consistent extra payments over and above the agreed upon monthly payment. Using our earlier example, if you agreed to a monthly payment of $1,321.51, you may choose to pay $1,500 per month, a difference of $178.49. On your monthly loan amortization schedule, for example, you would input that difference into the optional extra payments box to view the impact of that extra payment. And as you'll see, this regular extra payment will reduce your loan period by almost 2 years and reduce the total interest paid on your loan from $58,580.88 to just $46,576.20, a savings of over $12,000. 2. Sporadic extra payments. If you have a seasonal business or otherwise inconsistent revenue, there may be a few occasional times where you can afford to make extra payments on your loan. Let's pretend, for example, that $100,000 loan is for a fictional Christmas tree business. Because of the influx of revenue in every December, we can afford to make extra payments of $1,000 every January. To calculate the effects of these sporadic payments, you'll have to input them manually into your amortization schedule formula. By the end of your loan, we'll have made total early payments of $9,000, reduced our loan period by almost a year, saving over $5,900 in interest. And step 3, finally, which is a lump sum end payment. Finally, some business owners, as they near the end of the loan period, find that they just want it over and done with. If your business has become very successful and you have the cash on hand available, you may choose to make one lump sum payment to finish out your loan early. Or maybe you've chosen to sell your business and you're using part of the proceeds to pay off the rest of your loan. Back to our $100K term loan. Let's look at the impact of paying off the last $20,000 in one lump sum. By making a lump sum extra payment of $19,718.42, the amount that was the ending balance of payment number 104 before we added in the extra payment, we reduced the loan period by 1 year and 4 months and saved almost $1,500 in interest. Of course, the value of making any type of extra payments depends entirely on their amount and frequency. Throwing in an extra $100 here or there isn't likely to make a big difference, but every extra dollar you can put towards paying down your debt will make some impact towards shortening your loan period and saving you money. If you're considering making extra payments in any form, you can always go back to the loan amortization schedule to calculate the impact of that choice on the total length and cost of your loan. Prepayment penalties. Be aware that in some loan agreements there may be penalties for early payments. In these cases, unless you're making a very large early payment, the prepayment penalty will likely be more than you would save by paying early. There are even some lenders who won't forgive any interest if you pay off early, so be sure to double check your loan agreement for any penalty clauses before you decide to make extra payments. When not to use an amortization schedule. While the debt amortization schedule is a very useful tool for many loans, there are some loan products that don't amortize in a standard way, meaning the interest doesn't compound on a regular schedule, and borrowers don't make equal payments on a set schedule. Here are the 3 main instances where you likely won't want to use one. Merchant cash advance, aka factoring or business-to-business cash advance. When you take on an MCA loan, you're agreeing to repay the lender for principal plus interest and the fees through a daily percentage of your business's credit card sales. This can be a great solution for businesses with irregular revenue because you're not tied to a set daily or monthly payment that you may not be able to afford. However, because your payments vary based on your day-to-day sales, this loan product does not amortize at a set pace, so the payments can't be tracked through a standard loan amortization schedule calculator. Invoice factoring and invoice financing. Unlike most loan products, the cost of invoice financing and accounts receivable factoring are calculated based on a set factor fee, rather than an interest rate. Invoice financing is typically charged at a fee of around 0.5 to 1% of the advanced amount per week. With invoice factoring, the typical fee is 1% per month. In either case, the principal does not amortize, and there are no set payments to be made. Rather, the lender's fee is deducted from the amount issued to the borrower. Without amortization, compounding interest, or set payments, there's no need to use a schedule calculator in this case. And finally, line of credit. As opposed to a set loan with a set payment plan, taking on a line of credit works more like a credit card. You may have a balance on the line of credit, and your only requirement month to month is to make the interest payments on the principal. At any point, you may choose to pay back the principal on the line of credit at any pace you wish. While the interest compounds throughout the life of the line of credit, the debt would only start amortizing once you start paying down the principal. Some business owners will choose to pay down the principal on their line of credit with regular payments on a set schedule, in which case you could in theory use a loan amortization schedule to template to track that payment process. But in most cases, you'll need to manually calculate your interest costs based on how you actually use and pay down the line of credit. Know before you owe. No matter what type of debt you take on, it's imperative you fully understand the terms, conditions, and impact of your financing decisions, so that you can make the best and most informed decision possible for your business and your life. We hope this information and the loan amortization schedule templates will help you feel informed and empowered to approach your borrowing choices with confidence. Ladies and gentlemen, that's it for today. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, to purchase life insurance directly up to $1 million with an instant decision and no medical exam, or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description. With that being said, wipe ass. Work in progress every day and see success. Salute, salute, salute. Hey folks. This last video was sponsored by my company, where we help people like you to reach their financial goals. We do this through a simple conversation where we help to identify and then protect your lifestyle. And then we implement a plan. The process starts at about an hour. So, if you want more information or you want to schedule a consult, contact me via the information in the description box, and let's talk and see if we're actually a great fit for each other. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Thank you, and enjoy life.